Hi folks, welcome to another episode of Who Said What. I'm Kashish, and if you're new here, here's the quick context. The idea is simple. We pick the most interesting, sometimes spicy comments from business leaders and fund managers and break down what's really going on behind them. This builds on the newsletter we run called The Chatter by Zerodha, where we track what company management say in their earnings call or TV interviews. But instead of looking at those comments in isolation, this format zooms out a bit. We track one theme across companies and over time to see how the story evolves. The goal is to connect the dots and understand the deeper shifts shaping an industry. For today's episode, we cover how AI is changing the rules of Indian IT services industry. Now, this edition couldn't have happened without the help of my colleague and in-house IT expert, Pranav Mani, so huge shout out to him. For nearly 3 decades, the Indian IT services pitch was simple to draw on a whiteboard. Take the work that costs $150 per hour in New York, route it to engineers who cost a fraction of that in Bangalore, keep the spread, and scale that business by adding more engineers. The model was so durable that the Indian listed IT industry grew into a $250 billion plus export machine on the back of it. FY26 was the year that Loop got publicly disowned by the people running those companies themselves. Not because the clients stopped buying services, but because the management itself began naming the model's mortality on its earnings calls. Some of it called deflation, some called it accretive, some called it disruption they were inflicting on themselves before someone else did it to them. The vocabulary varied across management commentaries. The shape underneath, though, did not. What follows is FY26 in the words of the operators across 5 fractures in the old way of doing business. The first fracture is the load-bearing one. For 3 decades, headcount was the leading indicator for revenue at every Indian IT major. In FY26, the link visibly broke. Here is HCL CEO C. Vijayakumar in plain numbers. That is 2 years of growth without bodies. The word the industry has started using is non-linearity. It is a clean piece of jargon which is saying that the old way of doing business no longer governs how revenue is made. Infosys says the same thing in its own language. The most uncomfortable version of the same point came earlier in HCL's year when Vijayakumar was asked what happens to the people whose work is now being automated. Released is the operative word here, so is not readily deployable. The Indian IT majors employ a combined of 20 lakh people. Even small percentage shifts in redeployability translates to large absolute number of careers that have to find a new direction. Infosys is the outlier here, but the way it's framed is the more interesting part. CEO Salil Parekh confirmed Infosys had added 13,000 people through the first 3 quarters and would keep adding more. Now, if we read carefully here, that's not a defense of the old model. It's a hedge that the macro is still hungrier for engineers than AI is yet capable of replacing them. The decoupling is happening at HCL and Infosys already. At Infosys, it is for a moment being absorbed. The cleanest data point on the decoupling, though, comes from a company that didn't appear in this set of calls. Coforge, a mid-cap that has had the strongest growth print in the listed Indian IT services this year, grew revenue roughly 30% in FY26, while its employees' cost base grew only 20%. The gap between the two lines is the entire thesis of this section, expressed in a single income statement. Now, Coforge's management hasn't framed this on the call the way HCL's Vijayakumar has, but the numbers describe the same phenomenon. The unit of revenue is detaching from the unit of labor. The strangest thing about FY26 is that the same productivity gain shows up on one CFO's slide as a discount the company is forced to give to clients and on another's as a price premium that the company is finally able to charge. The cleanest illustration of the dichotomy is that Infosys' own CFO articulated both the views on the same earning call. On the accretive side, Jayesh pointed out that Infosys' pricing has actually firmed up and credited AI for it. And then a few questions later on the same call on the deflationary side. So both the statements are true. New AI-led work commands premium pricing because clients are still figuring out what it's worth. Existing services, however, where the productivity savings are quantifiable and the competition can match the offer, give the savings back. The phrase that AI is accretive or AI is deflationary describes the same underlying economics applied to two different parts of the book. HCL has taken the most explicit deflationary view in the industry to the point of pre-announcing the revenue it expects to lose in the future. By the end of the year, Vijayakumar has put numbers to it. A $100 million deal in the old shape, he said, was now closing for a closer to $80 million. And taking a longer view, he sized the structural drag on HCL's own portfolio. Now, to make room for that pivot, HCL ran a restructuring program through the year. The costs showed up plainly on Q4 P&L. The reported operating margin of 16.5% against the underlying 17.7%, a 120 basis point drag on the company that chose to absorb all of it in a single year. Infosys sits in the accretive camp, and Nitin Rakesh has been the most forceful about why. TCS, predictably more measured, made the same point on revenue productivity but flagged the timing wrinkle. Early stage AI delivery still carries investment costs that distort margin comparisons. The two camps are not actually contradicting each other. They're describing different ends of the same portfolio. The new AI work prices well because it's scarce and unmeasured. Old work that has been repriced under AI saving clauses gives the margin back. The companies whose CFOs are saying accretive are the ones whose mix is tilted today towards the new end. The ones who say deflation are sizing the headwind from the old end. FY27 will tell us which dominates as the new work scales up and the old work gets repriced. There is, however, a related move that two of the larger players have begun making, and it is the most concrete signal yet that they are willing to defend pricing with the one lever services firm rarely pull: walking away from deals. HCL's Vijay Kumar disclosed in Q4 that the company had voluntarily declined to chase a meaningful share of available pipeline. $1 billion of foregone total contract value is a serious admission for an industry that has measured its quarterly press releases in TCV growth for the past 2 decades. Tech Mahindra has been making the same call and saying so explicitly. Tech Mahindra CFO Rohit Anand confirmed the same posture in CFO language. So if the labor hour model is in retreat, what replaces it? The honest answer from FY26 is no one knows yet, but everyone is auditioning a candidate. The sharpest reframe came from Tech Mahindra CEO Mohit Joshi, the most transparent any large-cap Indian IT services chief executive has been about the pricing logic of the AI era. The token framing is borrowed deliberately from how large language models are priced. A unit of work abstracted from how it gets done. Whether the work is performed by a human in Pune, an agent on a GPU, or some blend of both, the client buys outcome by the token. Notice what it strips away: the offshoring rate card. There is no longer a billing rate in the traditional sense. Infosys has taken a different route to the same destination, selling the savings, not the hours. That sentence is worth pausing on. RFPs, or requests for proposals, have been the industry's procurement language for 30 years. A multi-100-page document goes out. Vendors respond with a multi-100-page document back. The decision is made on that document. If RFPs are being replaced by live sandbox demonstrations, the selling motion itself has changed. Showing the working AI agent in the room beats describing it. The sales force that wins is the one with engineering in the field, not slideware in the back office. Infosys more cautiously hinted that the pricing is in transition without committing to where it lands. Pod-based and studio-based are worth unpacking briefly. A pod is a small dedicated team, sometimes 10 people, sometimes 3 plus an agent stack, built as a unit rather than per head. A studio is a longer running engagement priced on capacity and outcomes. Both share a common property. The client never really sees an hourly rate, which is very different from how the industry used to work. If the work is no longer priced by the hour, where is the leverage? Every CEO in the brief converged on roughly the same answer. Stop being a pure services firm, start owning intellectual property and platforms that get embedded into client environments. HCL's Vijay Kumar said it most directly. The argument is structural. A consultancy that uses someone else's platform like Microsoft, Salesforce, ServiceNow, or OpenAI is actually renting leverage out. A consultancy that builds its own platform, even a narrow vertical one, captures the leverage. HCL's AI Force is the lead exhibit here. By the end of FY26, the company reported $155 million in quarterly advanced AI revenue, up from $100 million annual milestone just 2 quarters earlier. Wipro, in the most explicit organizational signal of the year, set up a separate business unit around the same thesis. Services as a software is the phrase to watch. It is the inverse of software as a service. Instead of subscription software that requires services around it, the service itself is delivered as software that runs continuously. The CEO described the resulting structure as dual engine. Traditional services on one side, AI native platforms on the other. Tech Mahindra is making the same move under a different label, rebranding entire service lines rather than just spinning up a new unit. TCS has stated the destination in the largest terms. The most provocative version of the labor to IBTSs, though, came from Infosys' co-founder and chairman, Nandan, in a line that pointed at something even further out. The threat to the SaaS industry the IT services companies have spent 20 years serving. If Nandan is right, the next chapter is not just IT services repricing labor. It is enterprise software being eaten by the same wave, and the consultancies that ride it being the ones that own the new application stack, not the old one. The final fracture is the most underappreciated one in the brief. The growth pocket nobody had on their bingo card 18 months ago has turned out to be the building, running, and feeding of AI itself, what HCL calls day one services. Edge inferencing is the act of running AI models on device, which is a car, a sensor, factory floor, or whatever, rather than in a centralized data center. Custom silicon is the chip designed to do that efficiently. Both used to be niche semiconductor specialties. In HCL's telling, they have become mainstream IT services work because every industrial company building AI capability now needs both. By Q4, HCL had a concrete deal to point to. TCS made the most striking infrastructure announcement of the year, a move into the data center business itself. 1 gigawatt of data center capacity, for context, is a serious number. Indian data center capacity in early 2026 totals roughly 1.4 gigawatt. TCS, a services company, has signaled it intends to build something approaching the size of the entire existing Indian co-location industry and intends to sell that capacity to AI workloads. The more interesting move underneath Hypervault, though, is what TCS is positioning around it. The company's stated aspiration of being full-stack AI services player, infrastructure to intelligence, reads at first like Investor Day boilerplate. Read against the Hypervault build-out, it describes a sequence no other Indian IT firm is set to deliver. An AI lab buys compute from TCS, then turns to TCS again for GPU operations, then cloud management, then the model fine-tuning and red teaming work that Wipro and Tech Mahindra are doing on project basis. Each successive layer is more services intensive and more margin rich than the layer below it. Owning the data center at the bottom of the stack gives TCS a contractual reason to be in the conversation at every layer above it. That is structurally accretive in a way that running someone else's GPUs cannot be. And for now, no other Indian IT firm has the balance sheet, the customer book, and the infrastructure muscle to attempt full stack the way TCS has. Wipro and Tech Mahindra are working a different end of the same picture, getting paid to run models for the model makers themselves. For a layer of context here, BPS, which is Business Process Services, used to be the lowest margin, most automatable layer of the Indian IT stack. The fact that 1/10 of Tech Mahindra's BPS book is now training and fine-tuning AI modules for hyperscalers is a sentence that would have read as nonsense 3 years ago. The hyperscalers, ironically, have become the buyers that need the most armies of human to label data, evaluate outputs, or red team models. The Indian IT services industry spent FY26 publicly admitting that its core business is changing shape and putting numbers, language, and organizational decisions behind that admission. The vocabulary fractured into deflation and accretion, tokens and pods, disrupted and native, but the underlying movement was a single one. The companies that used to sell engineering hours by thousands are now trying to sell platforms by the license, savings by the contract, and infrastructure by the gigawatt. None of them have completed the pivot. All of them have started it. FY27 is the year the math becomes legible, when new revenue mix is large enough to either validate the bet or expose the gap. And that's it for this edition. We'll see you in the next one.